Hello friends, and let's have a look at the week ahead in the financial markets. So the last week ended really bad for US dollar since Fed backtracked from its highly hawkish view that it had presented in December, and now only sees only 2 rate hikes happening this year, as opposed to their original view of 4 rate hikes. So dollar just got killed across the board, and the dovish Fed also gave equities another shot in the arm. And equity markets have now turned positive for 2016. But what is worth noting is that the reaction in the equity markets lagged the usual bang. We did not have these fireworks in the equity markets that we usually see after sudden backtracking by Fed from its hawkish view. So that tells us that this markets are not really markets do not take the dovish stance as positively as they used to take earlier. And over the weekend we had OECD economists stating that the global economy or the advanced economies are overloaded on monetary policy, or in simple terms, there's just over dependency on monetary policy tools, and that is not good, and that is being reflected in the financial markets right now. And that is the reason why we did not see markets react with a usual bang to the dovish Fed. Okay, coming to the next week, I guess oil prices could play a spoil sport because oil benchmarks, both WTI and crude, are closing in on the overbought territory, and that leaves the doors open for technical correction. Let's look at the Brent oil chart. I've got a Brent oil chart over here. So it's quite clear that we saw the first bullish break from the falling trend line on March 1, and that was extended further. Prices bounced off from the 100 DMA support and clocked a high of 42.51 on Friday. But look at the closing. The closing is at 41.40, and that means it is just below the March 8 high of 41.46. And if we zoom on the daily chart, it clearly tells us once again that it's a doji formation with a larger upper shadow, and that might be an indication that oil prices could fall back to this trend line, would flirt with this trend line level of $39. A break below the same would expose the 100 DMA. That would be around $38. So all in all, I guess oil appears due for a correction, and that is not a good news for equity markets, because equity markets are almost entirely dependent on oil now. And if oil doesn't rally, it's not a good news. Again, if we draw this rising channel of sort of formation, the key resistance level is around 43.25. So I would now wait to see if oil prices break above this rising channel formation, because a repeated rejection over here and we are going to have prices fall back to the rising channel support. And it's interesting to see that the larger falling trend line and the rising channel support, it's a confluence over around 38.70 levels. So a break below 38.70 and we go straight down to 32.99 or 33 levels. So that's not a good news. Apart from oil, another chart that I would like to point out is the pound dollar chart. I believe we have a symmetrical triangle bullish break, and prices might go down again to 1.4370 or flirt around with 1.4350, 1.4370. But if we see a rebound from the symmetrical triangle support, I guess we will be heading towards let's say we would be heading towards 1.4660 levels. Now that would be an interesting formation, because that would be a signal of, this would be a shoulder, this would be a head, and if it turns lower again, which I feel that it would, make an attempt to around 1.46 or 1.4660 levels and then turn lower, and that would be a signal that a right shoulder is being formed. So as a trader, I would watch out for a rebound from the falling trend line support or symmetrical support, and a rebound from here would be a clear-cut opportunity to enter into long sterling trades. Now, just a few minutes back we discussed oil. One of the interesting trade setups that we have over here is if equity markets start falling, I guess we would have a euro rally. So let's look at a euro dollar chart. If we see, a bullish break above 1.1376 is what we need, and if that happens, I guess euro pound would be a good trade to go in. But looking at charts, this looks horrible indeed. I mean, if I just look at this chart, I would personally either go short on euro pound, or looking at the overall picture, it just tells me that pound dollar is more likely to bounce back this support, the symmetrical triangle support, and head towards 1.4060. So as of now, I'm a pound bull, especially since we have had such a sharp recovery post Fed, and that got extended to 1.45 levels. And look at the daily closing on Thursday. It's well above the high 1.4436, and that just tells me that it's a bullish signal. It's a buy on dips kind of a chart. I would be worried about long positions or building up long positions if the currency pair dips below 1.4350 or 1.4284 levels of sort. Now another chart that I would like to talk about is the Dow Jones chart. It's really interesting. We had this sideways channel of sorts, and we had this bearish break in the first week of January, when that yuan slide once again caught markets high, and markets reacted. It was just a risk off sort of a panic in the markets, and it fell, but it rebounded from the 23.6 Fibonacci levels, and it made a double bottom formation. It witnessed a bullish break from double bottom, and it also re-entered the the channel. If we extend the lines, now we have it's well inside the channel, and is now actually heading to 17,630, 17,640 levels. But that's a very strong resistance, especially since oil prices are looking like exhausted. And if there is a correction in oil, I guess Dow Jones isn't going to see a bullish break above this channel trend line resistance. Even if it does so, I would look for more confirmation from oil. If we have, let's say, a bullish closing above the trend line, and if oil isn't really showing any fresh signs of bullish momentum, I would suggest that would be a bull trap in Dow Jones, and we are heading back to, let's say, 17,200 levels, or a worst case this week would be 17,000 levels. Another chart worth looking at, is NZDUSD. It's a really good chart to look at, especially if someone is short US dollar via other pairs. Let's say if I'm holding a short, I'm holding a long sterling trade, or I'm holding a long euro dollar trade. This is something that I would do for hedging. I would just short NZDUSD. So let's say if we have a miraculous recovery in US dollar, and if I'm stuck in long euro dollar pair or long GBP dollar pair, this would be a perfect hedge. Like if I enter short into NZDUSD, and if dollar begins a broad-based recovery, I guess the sell-off in NZDUSD would be far severe than what we would have in pound dollar or euro dollar pair. And looking at the chart, it just tells me that it's heading back to 0.67, and given the falling milk prices and the weak GDT auction that we had last week, and plus because of dovish Fed, there would be even the combined effect is that RBNZ would be under more pressure to ease, and I guess that is why NZD short is one of the best trades that we have right now. So keep tracking Maverick Trading blog throughout the week for regular updates, analysis, news. All the best for this week's trading. Hope everyone makes good money. Thank you.